The market melt-up continues as the S&P closes just pennies beneath its 200-day moving average. The index is now up nearly 17% from the depths of December, and it's been somewhat of a dash for trash as once beaten-down sectors like industrials and energy lead the way. But with the growth trade getting back in high gear in the last 2 weeks, is this a recipe for a bigger rally? Let's bring in Phil Camporeale, asset allocation strategist at JPMorgan Asset Management. Phil, great to have you with us.
Hello.
Why new highs? We're going to see new highs from here?
Yeah, so just to qualify that a little bit, not as bullish as we were at this point last year when every PMI and growth rate globally was going up at the same time.
Right.
However, nowhere near as bearish as what the market was telling us at the end of last year. So 3 reasons for that. So to quote the late, great Prince, this is what it sounds like when doves cry, right?
Wow.
I mean, I think
Love
that
this
is a clear pivot that Powell made, and people have talked about it a lot. It does 2 things. One, it eliminates some of that policy error concern, that tail risk of the Fed just moving too much kind of blindly. That was one of the reasons why we took equities down last year. The other thing it does, it elongates the cycle. So if you have a year this year where inflation stays around the Fed's target, growth stays positive, and earnings just stay positive, that's usually a good runway from here for stocks. The second is trade. And I heard the last segment, we don't expect some grand plan on trade by March 1st. However, there's low-hanging fruit. One of those low-hanging fruits is just no new tariffs. That would be a win in terms of certainty between China and U.S. trading partners. And I think the third is earnings. So earnings season this year hasn't been spectacular. I think 70% have beaten on EPS. That compares to high 70s of prior quarters. But there's a big difference this time. Companies that beat are rallying on average by over 2.5% that day, versus that's the best in 12 quarters. We haven't seen stuff like this, and a lot of that has to do with where we were kind of going into this earnings season with completely beaten down expectations. Right. So reasons to be optimistic, Melissa.
So is it more just that expectations have been reset, or is there a real change? You mentioned global PMIs, because global PMIs really indicated the downturn before a lot of the equity markets had indicated the downturn last year. Are we seeing an upturn? Are we seeing an inflection point in them, or no?
Yeah, so the way we're characterizing this, Melissa, is this is like a financial conditions rally, right? What does that mean? It means that the Fed, a lot like they did in prior parts of this cycle, are taking a pause. And you saw today, stocks up, bonds up, right? This is less of a fundamentally driven rally that we expect U.S. growth to be at 4% or earnings to be at mid-20s. So I would say less of a fundamental story of gangbuster growth, which is what we were saying last year, more of just the kind of financial conditions environment that is positive for taking risks. And by the way, China's doing stimulus as well. The dollar, the Fed being on the sideline, that's a positive EM story, and that's something we didn't say at all last year.
Does it worry you a little bit, though? So for a good part of last year, off of the Q1 lows, the market rallied and yields rallied too, right? And the markets were equity markets were comfortable with that. Now we've had this reversal in yields, and it's happening because the Fed has gotten a lot more dovish. Back to your little Prince quote. Doesn't that make you a little worried how late in the cycle we are, and betting for new highs at this point? I don't know. What are the catalysts?
Yeah. So the Fed has now introduced volatility as well. So they've backed themselves into the corner. If we see some sort of kind of gangbuster rally in the S&P blowing past 3,000 or something like that, or if we see inflation not cooperating and they have to come back in, we're not pricing that in. We think the Fed's going to be on the sideline for the better part of this year. So if that happens, that's a problem. And in terms of late cycle, I think there are 2 risks in late cycle. One is holding an asset class that falls. We saw that in the fourth quarter. The other risk is thinking that a recession is going to happen in 2 months, and it's like the last 2 years. So we're not talking about kind of 2013, 2014 type returns in the market. We're talking more about the elongated cycle based on the Fed telling us they're at a neutral rate. And that is very different from December. In December, they told us we want to go a couple of more times, and we're not going to adjust the balance sheet, right? So they have made a complete 180 on that.
Phil, thanks for coming by.
Sure.
Good to see you. Phil Camporeale, JPMorgan Asset Management. Pete, are you as bullish as Phil is?
I don't know that I'm as bullish as what I'm hearing, but from what I see out there, I mean, this has been the greatest trading environment in the last 3, 4, 5 weeks that I've seen in a long time. I mean, it's been kind of crazy. The moves that we're seeing in short periods of time, whether you're talking about some of these FANG names or some of the industrial names, it doesn't matter. Pick your poison other than financials. We are seeing movements that's very, very rapid. And so am I bullish that that's going to continue? Probably not. But I do like the environment that he's talking about, which is, hey, look, maybe the trade's not completely taken care of, this trade war, but at the same time, maybe they extend it out and just stop the tariff talk back and forth against one another.
But don't you get back into that same box where the markets go up enough and then the Fed may pivot again? I mean, if we're celebrating the Fed for pivoting,
it goes up too much.
Exactly, because of market volatility and a change in conditions, the Fed can do the opposite too if things reverse.
If things reverse, I don't know how far. I don't know they'll wait to exactly fair value. They'll probably wait a little longer. I'm not as excited. He gets very excited, apparently, which is good.
Hey,
I'm not, but I don't want to trade around things. But with the volatility index coming down as much as it has, I think in the mid-teens, I'm going to start buying some more protection against the long.
Yeah, so we're bullish. I do think that that the Fed is on pause right now. I call it the Powell pause. I think trade right now is the most important thing because I do believe that the Fed's pause is really the majority of it's priced in. I mean, last January, we were at a forward PE on the S&P 500 of about 18. We came limping into January 1st of this year at a forward PE down at 14. We're back almost up to 16. I think that's pretty reasonable given where the Fed is at right now. Now we need to see some progress on trade. I don't think we're going to get a deal done by March 1st. We just saw the longest punt in Super Bowl history on Sunday. It was the only exciting thing that happened. I think we're going to see a punt. I don't think we're going to see anything by March 1st.
Yeah, I guess what I was just trying to say is that yields going down for the wrong reasons this time, with crude oil pausing maybe for like reasons that aren't great for the global economy. We already talked about the Baltic Dry. And then you think about what's one group that really has not participated in the U.S. market here over the last couple weeks, which I think is really important. He was telling you the tale all last year, and that's banks. They just cannot get going since that period right after earnings. So to me, I think there's enough reasons as the market feels like it's just floating up a little bit more. It's right at that 200-day moving average in the S&P 500. There's enough reasons to not get in there and buy at this point because you feel like you missed out.